Hello everyone, thank you for joining us today at Real Estate Talk Today. My name is Jeff Infante. I have my partners here, Josh DeBrossard.
What's up?
Jenny Clement. And again, Jeff Infante. And today we have a special guest, as we always do. And we're gonna talk a little bit about the mortgage and the interest rates and everything that's going on in the market today. And today we have Steve Johnson with us. Steve, how you doing?
Good, good. What's up, everybody? Hi, how are you?
It's a pleasure to have you with us. And Steve, as always, we want you to introduce yourself so those that are hearing can know who you are, what you do, how long you've been doing it.
Sure. No, Thank you. Appreciate you guys having me here. It's
welcome.
an honor, obviously. I love this whole setup. I love social. I've been doing this now for 26 years. I started back in '96 as a junior underwriter, so I had a real good foundation of kind of what was going on and just how to present a loan, how to make sure it goes through the right way, and from there, I just started to become in sales, became a loan officer because I was like just looking at how things worked and how they get to interact with people. And for me, that was more important because as a underwriter, I didn't get enough chance to really work with the people directly. Right. And I like that. That makes a difference to me. I like to be able to do that because I can see more of an impact with people. So it's good. But I work at Loan Depot. Right. We're in East Providence, and I'm the producing branch manager there.
Oh, nice.
So,
perfect.
Yeah.
All right. So we're gonna ask a few questions, right?
Yeah.
And I know that things change. The market's changing frequently. Things are happening, just around us in general. I mean, there's a lot of chaos going on in this world, we all know. But, tell us a little about what would be your suggestion for someone that's looking right now, that's thinking about purchasing a home for the first time? What would be that ideal thing you would say to them?
So the way I look at it is I try to go with the end in mind, right? Where they're at that conference table and then that seller is sliding those keys to the buyer, right? So if I begin there, then I can backtrack because everybody doesn't start in the same spot, right? So someone might have a down payment as a gift. Someone might have a big down payment. Someone might not have any down payment. Okay. So what I try to do is I try to tailor it to the person. So if somebody is in, let's just take an example of someone who doesn't have any down payment, right? That person, I would suggest that you look at maybe some options for down payment assistance, okay? That's where you really want to start and say, well, where do I get that? Talk to a loan officer, right? So you want to start with a lender versus, I think sometimes some people think to go to a realtor, which is a great time, a great thing to do is to go to a realtor because then you'll have connections with good lenders. But you want to always get to that lender so then you can work to see what's your particular situation. So in that example of someone who doesn't have any down payment, I would suggest that we look at what's the credit look like? What does the income look like? What do your other alternative debts look like? We want to make sure that what we're doing is putting them in a position to be successful and not really overstress themselves, right? Are they renting right now? Are they living at home? Like, what's that payment shock going to look like? But the first thing I would say is get to a lender either through a realtor or go directly to a lender. And I have to say the best thing I think you can do is to go local with a lender in your particular market. When you do that, let's face it, it's a big community, but it's a small community in a lot of ways because you see so many of the same faces and you work with the same people, right, over and over again. So hey, I can make sure that this person's well taken care of as you're recommending a lender to somebody. It makes a big difference. So I would say go to a local lender and or go to a realtor who can then get you in touch with a local lender, and they're going to look at a few different options for you as far as like what your credit looks like, where are you going to start from that point? Are you okay to kind of proceed, or do you have to kind of wait a little bit? Right.
I'm actually glad that you said that about working with the local lenders because sometimes I have to talk to some of my clients that come pre-approved with those banks online that we don't even know where they are, where they come from and stuff like that. And sometimes we can't even communicate. Everything got to be through emails and business hours from, 9 to 4, whatever, and no weekends and stuff like that.
Depending where they're from, because the time zone is different too.
That too.
If they're in California,
True.
it's a whole different.
Well, you hit on that, right, with the communication. That's perfect because you need to have that communication. Sometimes, guess what? In your world and my world, it happens after hours, after 5 o'clock. So you want to make sure you're available or have someone who you can work with that is available because I know you're available on the weekends. You're working every weekend, so it makes sense.
And it makes a difference because it just happened a couple of weeks ago. I had a new client that came to me. She was pre-approved with one of those banks online. And she was a new client, so I was like, okay, we submitted a couple of offers, nothing. It didn't even get accepted. Then I suggested, you know what, why don't you work with one of our partners, right? This is a person that I recommend, and she did. She listened to me. She got pre-approved. Then we submitted an offer, and boom, she got approved. She got accepted. You know what I mean? Because that makes a difference. Because us as agent, right? We see the first thing we see when we see a pre-approval, we're like, who's the lender? And if that lender,
you have to, because you want to know, right, that they're a good lender. And by a good lender, what I mean is someone who is going those extra steps that you need to take in order to get an approval. So such as making sure that the income is verified, the assets are verified, making sure that the credit is up to par. And if it's, especially in this market, with the rates going up, that the rate you had yesterday is not the rate you might have today, right? You can't go back in time. Rates were great for a long time. Kind of want to also say rates are still great. Historically, compared to 2 summers ago, no, they're so much higher. But that doesn't mean that you can't still purchase property. But you have to keep in touch with what the rates are doing with your loan officer to make sure each week, hey, where are we at? Are we still kind of on target with just what we anticipated for? Say you were approved for 450. Well, now the rates have gone up a point. It might be 400 now. So let's make sure you keep, if you're right on the edge of that, just make sure that you're still good with the payment. So especially someone who's a first-time home buyer, you have to continually check in with your loan officer to make sure you're getting the right rates and the right payment. Right? You might think a payment is one thing 2 months ago. It's not the same now. It's higher.
Right. I don't want to keep. But what about when people when do they lock the rate? Like they come to you and then you see, okay, you could get whatever, 4 point whatever, but then they don't find a house till like a month later. When do you actually lock the rate?
Okay, so for anyone who's buying a house, there's 2 options: lock or don't lock. Right? Okay. Now you can do a long-term lock. So we can do a lock up to 180 days, right? So let's call it 6 months, right? That's 180 days, 6 months. When you do that, I don't particularly advise anyone to do that because you're locking in a worse rate, a higher rate, I should say, right? Because now there's risk that needs to be taken on the lender side, whether it's our company or any other company, a bank, if they have it, if they offer that. So we have to go with a lot higher rate, right? Not a lot higher, but let's say if the rate today is 4.75, for example, and this is today 3.30 to 22. So in the future, if someone's watching this and the rates are higher or lower,
you have to disclose the date. I like that.
Yeah, so you know how that goes. Today we're at 4.75, right? But now let's say if we have to go with a 6-month rate lock, we're looking at maybe 4.99 or 4 1/8, or sorry, 5 1/8, 5.125. So if we do that, okay, well now why lock in that higher rate when, who knows, rates might come down. And if it does start to go up that way, but it takes 30 days to get there or 60 days to get there, well now maybe we could do a 3-month lock or something, right? And now that rate won't be as bad and you kind of be right where you're at. I say when you're doing a long-term lock, you're locking in a worse rate. So I kind of don't really advise anyone to do that because I'm on top of the rates all the time. As far as the markets, every day we're looking at seeing what's going on with it. So I wouldn't do that. And the other option is don't, or you just let it roll, and that's what I would do. Is just not lock it right away.
Okay.
See what you said right there, Steve, that I love was that you're on top of it. You're a local lender looking at your market in your area. When the clients are working with these out-of-state companies, they're like literally in a different time zone, as we were saying. Yeah. So they're not doing their homework on every state they service. There's no way. There's too many.
Well, what's different about that? And so look, if we're all, this is obviously going to go all across the country, all across the world, right? So somebody who wants to see property in a different state and they do get a different lender. Out of state, I should say, what the hard part that they have to deal with is they don't know the local down payment assistance programs, right? Or they're not as in tune to it, right? Yeah. If they are, God bless them, because there's 50 states, right? So there's a lot that you have to get knowledgeable on. Like that can be a little bit difficult. So that's when I agree, having a local lender is certainly a big help for somebody.
Yeah.
So,
what's the fee if, let's say, someone locks in, they have to extend? What does that typically cost? Because I know that some buyers, when some of our deals, they get a little bit anxious or like, oh, my rate's gonna expire, I'm gonna have to pay this much money. Right. Like typically, what is like a rule of thumb of what that cost is?
So let's say you lock typically for 30 days, right? Okay. So you're in contract and it's gonna be 25-day close, we lock for 30, so then you just say, okay, we're going to go over for some reason. Appraisal came in late, or there's
Yeah.
some issues with the inspection, and it just went a little bit over. Now we're at like 32, 33 days. We always have a 4-day free rate lock extension, okay? So now you say, okay, that's fine. You've got 4 days free, so you get a little bit of wiggle room. But if we have to go beyond that, then we could do a 7-day rate lock, extension, I should say. And then with that, that's going to be 1/8 of a point. So 1/8 is 0.125 of the actual loan size. So if you had a $100,000 loan, that'll be $125 in actual dollar terms, right?
Okay.
No, for that
the week.
7-day
For 7
extension,
days. Oh,
right?
okay.
So if you
That's
did
not that
that,
bad.
it goes then for us at 7, and then 15, and then 30. So you can kind of choose between those. So it's a 1/4 of a point for 15 days. So you kind of actually get an extra day by doing it that way versus 7 and 7. So just depends. It doesn't cost that much. It shouldn't have to happen, but sometimes
Right, it
occasionally
does.
it does. But
Right.
so it's about 1/8 of a point.
Right.
And then, as you guys all know, depending upon whose fault it is, if it's the seller's fault,
Right.
maybe you can kind of negotiate
Right.
that. The seller can maybe, or the buyer's agent can maybe negotiate that.
Right.
This market may be a little tough.
Well, because right now in this market, what we're seeing is right now we have the sellers doing the subject to suitable housing
Yes.
type thing, right?
Covered.
So now the buyers are pushing through their loan, right? But now they're waiting now for the seller to find a home, and then that pushes the situation where that rate lock might come into might come in handy, right?
Yeah,
or might
for
come
sure.
into effect.
Domino effect, right?
Yeah.
If one doesn't go,
Right.
then all of a sudden it's holding everything back.
Right,
Yeah.
right,
Yeah.
absolutely. So, for those that are listening too, I know, from your knowledge, interest rates are climbing up. Are banks tightening up their process in terms of qualification, like credit, like what's required? So usually that happens, right? When the economy starts to shift a little bit, they tend to tighten up a little bit, and they don't want to let go of the money, right? So, what is your thoughts on that?
Historically, it depends.
Okay.
Always, right? Depends on what the situation is.
Right.
With where we're at right now in this cycle, okay, and I mean that obviously we've been expanding, the inflation's going through the roof. We're seeing that the home values continue to increase, which is great, right? If you own property, great. If you don't, it's terrible. Having to watch that, you don't want to see that. But we're right now not doing anything in terms of clamping down on qualifications. Okay, so for instance, if you've got like FHA, VA, and they're at 580 for FHA 3.5% down. There's a credit score, 580 credit score. For the 3.5% down for the FHA and VA, there's nothing down, but you only need a 580 score for that. For conventional, which is Fannie Mae, Freddie Mac, we need 620 as a minimum. Okay, and then the 620 minimum also is the same thing for the USDA as well, which is a 100% program. With the conventional loans, you can do 620 with 3% down with their first-time homebuyer programs. There's some restrictions on that. That has to do with you couldn't have owned a home in the last 3 years, and then there's some income adjustments. You can't go over the adjusted gross income for the area, right? So the area median income, I should say.
Okay.
And so with those things there, they've been pretty steady for the last few years. What has been nice though is the amount for the loan amount that we can go to as a maximum has increased pretty steadily. So yeah, that's helped out because values are just going up so much. So they've kind of kept in step. All the GSEs, Fannie Mae, Freddie Mac, with what they'll allow for the max loan amount, right? Before it turns into a jumbo loan. So, but yeah. So now to answer your question, that was a long answer.
Yeah.
For it. No, we haven't changed
Good.
anything.
That's good.
No, it's awesome.
So, Steve, what programs do you guys have for first-time home buyers?
Okay, so for first-time home buyers, it really depends on what their situation calls for, right? So if they, for some reason, just got a nice gift and they have 20% down, I would go with a conventional loan, right? But we all know that doesn't happen quite all that often, right? So
No.
they're going to be looking at something which is traditional. In my world, I want to see what the story is for them in terms of what do they call for, right? Are they looking for single family? Are they looking for multifamily condo? Now, are they prior service member? Are they someone who, and if that's the case, then they could be eligible for a VA loan, right? Depends upon then where they're looking, okay? Are they going to be maybe in the outskirts, not, so much in like a city core? If they are, maybe we could look at a USDA, depending upon how much money they have to put down. So I try to tie it into what that specific need is for that person, right? So let's say that they don't have much money down. I would look at an FHA depending upon now what their credit is, right? So there's a lot of variables that kind of are in place for us to discern what's going to be the best option for that person. And quite honestly, it should be, because if I or any other loan officer just throws something out there at them and says, that's going to be one size fits all, I really want to tailor it. So let's say for someone who's got like a 680 credit score or a 650 credit score, I'm going to look at both FHA and I'm going to look at conventional, because now conventional will have a little bit higher interest rate maybe than someone who has like a 740 or higher. So now maybe they'll be in line with what the FHA rates would be, right? Because it just really depends upon what their circumstances are. But I would look at really kind of all of them to then tie it back into what's going to be best for them. But if I was just to pull something out, I would say ideally I'd go with conventional 3% down first, because they have a reduced mortgage insurance with that.
Right.
And then if that's not going to work out for them, I'll compare that with the FHA 3.5% down, see what that works, see what that's going to look like for them. So a couple of different options, just depending upon what it is that it calls for them. And I will say this, the best loan out there is VA. If you are a former service member, or even if you're a current service member, obviously, that's the best loan around. There's no mortgage insurance, and you don't have to put any money down. Very, very good loan. And it helps out this.
Duty, they can't foreclose on you.
Yeah. Hopefully it doesn't happen, right? You know, but you know, circumstances sometimes dictate, right? Family members, something happens bad, that, you know, it could happen. But yeah, for sure, that's right. But great loan. I love it if I can get people into that.
Quick question, another program I want to talk about a little bit. I don't know if you guys offer this, the no documentation loan program. What is it, and who is it fit for?
So we do, is the short answer to that, right? So we do what's called a bank statement program, which, depending upon your loan size, what we will require, either 12 months or 24 months, depending upon your loan size, right? It also will tie into your credit score. So basically what it's going to be is an average of what the amount of your deposits are on that particular bank account that you're using, right? It's going to be a business account.
Right.
So we'll take an average of that, and that's going to be what we would use as the income on a monthly basis to get that person qualified. That's typically going to be for someone who's self-employed, okay? And for whatever reason, they're just not, they're not, not claiming all right, they're claiming it, right? But they just have a lot of business expenses, and they have to write that off. So they're showing some income, but then it just doesn't come out in through the taxes.
Deductions.
Right.
They have a lot of deductions. So that seems to be a good fit for that type of a customer. We also have something that's called a debt service coverage loan. So basically that's going to be for someone who wants to buy a multifamily, okay? We can go up to an 8-unit. So with an 8-unit, it can be mixed use. It can be meaning that it could have, say, like on the bottom, maybe some sort of an office or storefront, and then up above it, it would have some sort of residential, right? So we could use debt service coverage, which basically means if you've got 8 units, and just for example, you're using $8,000 a month or $1,000 for each, and you're getting $8,000 in, and then the mortgage is, $500. Well, you're covering it, right? You just have to be at 1-to-1, 100% coverage, or 110% coverage. And in that example, you would. But mainly that would be for someone who just wants to buy a multi, but for some reason doesn't have the income to show, right? Because they're writing a lot of stuff off.
Perfect.
But
So
nice programs.
When you say that cover, that means that the rent have to cover the mortgage.
Correct.
Okay.
Yeah.
Just to make
So
sure.
debt service coverage, it's great. Honestly, it's a great program for sure.
You have that other great program that you showed me yesterday with the $7,000 credit. Can you touch on that a little?
Yeah. So what that is we have a sister company. My company, Loan Depot, has a sister company called Mellow Home, right? And what happens is realtors will be able to get signed up for that program, and then the realtors will be able to receive referrals from that program. So on our side, Loan Depot, we'll get customers in, and then sometimes they'll work out, sometimes they won't, but the ones that do, we can then turn those over into referrals. Now, the $7,000 comes into play where you can get up to $7,000 if you have if a customer comes in.
The customer
will get that money, right? After the closing. So let's start at that. Customer after closing will get $7,000. How that happens is they would go through the Mellow Home program. They would get pre-approved. They'd have a house to sell, and then they would use you as the agent to sell and list that property, and then help them find a new property. So they'd be able to get on both sides. So it's $3,500 for each. Now, if they didn't have a house to sell, then they could get up to $3,500 if they just used us as the lender and you as the realtor. So it's a nice program. It's able to help put more money into people's pockets at the exact time that they actually need it when they do purchase a house, in case they're going to be buying some new furniture or they need to kind of put in a new shower head that they want.
A housewarming gift.
Yeah, it's not. Oh, that's a great housewarming gift, in my opinion. Absolutely.
And that's on top of like the closing costs that they're gonna.
That's completely
get.
separate.
That's
It's not-
separate. After
they get that
closing,
money
they get
back.
a check.
Yeah, absolutely.
Does that work for second buyers, or has to be a first-time buyer?
It's for anybody.
Anybody that goes through the.
Yeah, you don't have to be a first time. It's not like a first time home buyer thing at that at all. No, it's a nice program.
So
I
when
won't
buy
put
my
myself
next
through
house,
this program.
I'm gonna do that.
That's the way to do
Get
it.
my 3,500.
I think I'm going to do the same thing.
I'm gonna refer myself to myself.
I want to do it now too.
Oh, there you go.
No.
I'll help you. Can we do that?
Oh no.
I'll be your agent.
No, but you know, this next question I have for you, I actually love it because it's a great. I'm huge on educating the client, and it's a great opportunity to educate the client. The question is, when you have a client who's just pre-approved, super excited, wants to buy a house, or even is already under contract for their house, what are the red flags or things they should watch out for or not do to not mess up the process?
I'm glad you asked. This very rarely happens, but if it does, oh my God, it sticks right in my, it shouldn't, it's not good. So what people could do to kind of mess things up, right? So you're pre-approved, you're in contract, you're ready to close in 30 days, everything's good. A week before you close, you go out and say, God, you know what, we really need a new couch. And while we're there, we might as well get a recliner. I need a new dining room table, honey, let's go. And you go buy $15,000 worth of furniture. But now that's not always gonna be a problem, but it's a problem if you have a tight debt to income ratio. Debt to income ratio being the amount of total debts you have, including your new mortgage that's about to happen, as opposed to what you make for income, right? So if that happens and now your debt to income ratio goes too high, it could kill the loan. We don't want that
Most
to
of
happen.
the time, the people are really, really there. They're like, they can't
I
even
tell everybody,
squeeze
wait,
anything.
just wait a week.
Can't even
If you have to
breathe.
buy it, wait a week.
Don't
Yeah,
buy the new
exactly.
car. don't
not
leave your
before.
job,
Do it
please.
after, please.
No, none
So,
of that.
yeah, no, we try to make sure, but I'm glad you asked that. Thank you, because that sometimes could derail everything. We don't want that.
Right.
So,
So we already talked about what people need to do for first-time buyers, right? But
Mm-hmm.
what do you suggest for people that want to buy their second home, the third home?
Which is
okay.
like the Burr method, right?
No.
No, this
No?
will be a little different.
Yeah, if you're gonna say you're gonna buy a second home,
Yeah.
or not a second home, but it's your second home. You already own a house, and now you're gonna go purchase a new home. You have a luxury, especially in this market right now, of having so much equity, ideally built into your home. So you're gonna have a lot of money now to put down. Okay, you can look at a couple of different options, especially in this market. You could look at putting 20% down. But we all know you have to offer, at this point, over ask. You're not, I saw a nice graphic yesterday of the percentage of people who were able to get their offers accepted at ask. And it was like next to nothing, right? Then it was like 20% with 10%. And 20% of the people who were putting in offers were able to get their offer accepted at 10% over.
Yeah.
And then the people who were really getting it were about 20%
Yeah.
plus over, right? Over
Yes.
asking. So that's what we saw. So what I would suggest is you could put the 20% down if you have that, and then you want to save some money and put it aside for an appraisal gap. So if there's a gap on that purchase price, let's say we'll use 500,000 as an example, right? So let's say the list is 400,000, you want to put down 80,000, but you're like, well, wait a second, I can put down 80, but I've got, I just sold my house and I've got, 150,000. You want some money in reserves to then say, wait a second, we're going to offer 5. But instead of doing it based on 80,000 down with a 20% down payment, let's go to 500,000, and now we can put down maybe 10%. You'll still have a little bit of mortgage insurance, but your payment difference is really next to very, very little difference.
Yeah.
So I would suggest that people look at those options. Let's see what's in the market, how many houses are available for you to purchase, but then look at those two options, either 20% down if you've got enough money to do that and have money left over for an appraisal gaps, shortage, a shortfall in the appraisal if it comes in low. Or say the house is selling for 500, but the appraisal only comes in for 450. You've got to come up with that additional 50,000 to make up the difference. You want that money set aside. So if you're going to be doing that, if you're going to be purchasing a home and you already have the luxury of your own home to sell, make sure you've got enough money for that appraisal shortage. And I would look at those two options, either 20% down or a little bit less with more money to put towards the gap, if it should come up.
And they could do a refinance to get that 20% down, right?
You could always do that after, right? If you tried to refinance after, then that appraisal has to come in, right, at that higher amount.
What I'm saying is they're gonna refinance their current home to get some money out to use it for their second home, no?
Oh,
you
so
suggest
you're talking, yeah, I like that idea too. If someone has that mindset to be a landlord, I'm a landlord. I have 2 different investment properties, right? And I love it. So if that person wants to do that, I love the fact that they could keep that property, refinance that property to take the cash out, and now use that to go purchase your next property, and now you can use the rent from that other property. I currently do that now, and I love it, to help pay for the mortgage that you're going into. If someone does that, I think that's an absolutely great idea to do that. That leads me to something we can talk about too, which is what's called the BRRRR method, right? BRRRR method, and I think you had mentioned that before, right? That stands for anyone who doesn't know, it's buy, renovate, buy, renovate, rent, refinance, repeat. So you do that over and over again. So you could theoretically do that on as many houses as you can that conventional will allow, right? So I think conventional Fannie Mae will go to 10, and I think Freddie Mac will go to 7, or vice versa. I have to double check, but it's one or the other. But I know one will go to 10, so you can do that 10 times. Meaning you can buy a property, you either buy a single family or a multi, 2, 3, or 4 in conventional loans, and then at that point you can rent out the other units, or you can go ahead and just live in that property. Ideally, it's a multi. There's not a lot of singles in the area. Here we're blessed to have enough, right, that we could do that with the multis. But you rent out those other units, you fix it up, and then you go ahead and refinance and take your cash back out that you initially put in for that property, right? Because on your first loan, you're going to do an FHA loan, right? Because you only need to do 3.5% down, especially when it comes to a 2, 3, or 4 unit. That's the key, because now you only have to put down that 3.5%, and then you can cash out with that refinance after, right? So it just depends on what type of program you're using and how much money you have to put up front. But ideally, once you've renovated that property, that value's gone up, and now you can get out of that with a conventional loan, go into your next property with an FHA again, and repeat that whole process all over again. It's a great strategy.
Yeah. I love it.
I love it too.
I practice it.
Yeah, I practice what I preach too. I've done it.
No, thank you, Steve. We really appreciate your time today. That's awesome. I mean, it's all very informative information, especially for those that are listening. I think that, in these times, I think that the consumer should be educated and should know what's going on in today's market. People do want to buy, and, a lot of folks have that scarce mentality, whereas they don't know whether to move forward or not. But, here we are providing that content over to them to say, hey, listen, step forward with faith, you'll be fine, right? Interest rates, they're still relatively in good shape, right?
Absolutely.
Even if we hit the 6, it's still good, right?
Historically,
right.
Absolutely.
So, so a lot of people, we tell them that, and sometimes they don't believe us, and sometimes they do, but this is why we do what we do, and we thank you for joining us today here.
Thank you. I appreciate it. I appreciate the opportunity to be here. And for me, just like you said, sometimes they will kind of believe us or not. I try to make sure that everybody knows I'm coming from the heart with this, where I make sure that they know, look, if you do this transaction, it's to benefit you, right? It's not to put you ever in a bad position, because if that's the case, we all lose, right? Nobody wants that. Everybody wants to make sure that they're putting themselves into the best position that they possibly could be in. And quite honestly, are your goals to be a homeowner or your goals to be a renter, and how do you change that, right? What gets you out of that mindset of being a renter, right? If you're only going to be around here in the area for a short time, you probably should rent for a year, 2. But if it's going to be anything longer than that, then you have to know, what I'm telling you, and I'm suggesting everybody become an owner at some point in their life, right? It's forced savings. It's a forced piggy bank, quite honestly, right? So I believe in that 110%. So for sure.
Awesome.
But thank you for having me. I appreciate it.
Thank you for joining us. Thank you. Guys, have any other questions?
No, thank you very
Steve.
much, Steve.
Awesome.
Yeah, thanks for having me. I appreciate
Good
it.
stuff.
All right. Well, we'll conclude it here today. Well, guys, thank you for joining us. I hope you guys enjoyed our show today, Real Estate Talk Today. Again, my name is Jeff Infante, Josh DeBrossard, Jenny Clements. On to the next episode. Take care. Bye-bye.